There we go. Good evening, everybody, and welcome to today's comprehensive educational session on Dow's Theory. I am so thrilled to have all of you here with me as we unpack one of the most foundational theories in the world when it comes to market analysis. So, if you've ever looked at a chart or wondered why trends form or why they persist and what truly drives them, then this session is tailor-made for you. Kindly just let me know in the comment section if you can all hear me loud and clearly. I would really appreciate that. Also, let me know where you are logging in from. And as always, don't forget to click that like and subscribe button. Now, you will see that my environment looks a little bit different tonight. I was kicked out of my studio for maintenance purposes. So I'm sitting in my office at the moment and just giving the session from here on forward, as at the end of the day, you guys are the most important to me. So regardless of what happens, I will be here guiding you guys through the markets and providing quality education. Now, you are going to see that what we are covering tonight on Dow's Theory ties in very nicely with the series that we just completed on smart money concepts. Now, Dow's theories are some of the original versions of technical analysis. If I can put it in this way, Dow was the founder of technical analysis as we know it today. So yeah, there's a lot for us to cover and there's a lot that we are going to go through. And yeah, then we're going to go from there onwards. I do see I have some comments coming through. Roka says, yes, can hear you and logging in from Cape Town. That's absolutely fantastic. So yep, let's actually get into the session. As we get in, just obviously have to cover some of the nitty-gritties. So that being said, please remember that everything that I will be covering tonight is for educational purposes only, and at no point in stage will I be providing financial advice. Should you want to read these disclaimers in more detail, they are also available below in the comment section. Or sorry, not in the comment section, in the description. That being said, let's get into tonight and let's go and see what we can learn here tonight. Now, Dow's theory is over a century old. This is absolutely crazy to think about. Yet, its core principles that remain as relevant today as they were when Charles Dow first formulated them in the early 1900s. So whether you trade Forex, commodities, indices, or stocks, this theory serves as the DNA behind most of modern technical analysis. So by the end of tonight's session, you'll not only understand how Dow's theory works, but you'll also know how to apply it to your trading. And like I said, if you apply it to what we discussed during the last 3 sessions with regards to SMC, it would make everything a lot more clear to you and you'll see everything kind of just clicks very easily. Okay, so let's dive in and explore what Charles Dow discovered. So this is a framework that continues to shape the way traders and investors view price action, volume, and psychology. So I want to kick off with a question for you all tonight here. So how many of you have heard of the Dow theory before today? And have you ever applied it into your own analysis? Please let me know in the comments. So have you ever heard of the Dow theory prior to tonight's session? And have you ever applied it into your analysis? So while you are typing that out for me, what we are going to do is we're going to move over and we're going to have a look at, just exactly who who Charles Dow actually was, and just to give a little bit of a background, if we can get it in that way. So here we go. So before we can understand the theory, we need to understand the man behind it. Now, Charles Dow was born in 1851 in the USA. So he was a mathematician or an economist by trading. So by training, if we can put it that way. However, his profession was a journalist. Now, his passion was for observation and storytelling, and those skills led him to become one of the most influential figures in financial history. Now, in 1882, Dow co-founded what we now know as the Dow Jones and Company, which also, if you all trade US 30, it's all part of that. So, and he did this alongside Edward Jones. Now, later he became the first editor of the Wall Street Journal, a publication that remains one of the most respected financial newspapers to this day. I mean, just these two things, founded one of the largest financial companies in the world, was the first editor of the Wall Street Journal. Just all these things, like, you guys can see what magnitude this person had within the financial industry starting out. So yeah, now through his editorials, Dow shared his observations on how markets moved, how trends developed, and how investor psychology played a major role in price behavior. What's remarkable is that Charles Dow, never actually published a formal document calling it the Dow Theory. So he never named his strategy. I mean, how crazy is that actually, Dow's primary goal was just to bring order to market chaos. He wanted everyday investors to understand that markets move in structured patterns, and that if you could recognize those patterns, you could make far more rational trading decisions. Now, why does Dow's theory still matter? And again, this is a valid question. So, as we all might be wondering, why should a theory developed more than a century ago still matter today? The answer is simple. Markets evolve, but human behavior doesn't. Dow's theory isn't about technology or indicators or fancy algorithms. It's about understanding collective human psychology and how it manifests in price movement. Now, every modern trend following strategy, every moving average system, and even every Elliott wave theory can trace their philosophical roots back to the ideas that Charles Dow first articulated. The beauty of the Dow theory lies in its simplicity. It doesn't rely on predictions, it relies on observation. Now, Charles Dow had 6 tenets of the Dow theory. So what we're going to do is I'm going to walk you through these 6 key principles that define the Dow theory, each one building upon the other to create a complete picture of how the market moves. So let's get into that. Sorry, wrong one. There we go. Here we go. So number 1, markets move in 3 trends. We have the primary trend, the secondary trend, and the minor trend. I will show an example of this later. Now, the primary trend represents the bigger picture, a long-term movement that can last for years. The secondary trend is the counter move, a temporary correction within that larger trend. And the minor trend is the daily noise or fluctuations that occur within those broader movements. Now, number 2 is markets move in 3 phases. And again, I'm going to break this down for you guys as we go. Phase 1 is accumulation. Phase 2 is participation. And phase 3 is distribution. These phases represent the psychological stages of market behavior. From smart money entering quietly, again, as I said earlier, this ties in beautifully to smart money concepts. But I don't want to get ahead of myself now, So as I was saying, from smart money entering quietly to public jumping in, retail traders, and finally profit taking at the top. Now, rule number 3 was price discounts everything. So according to Dow, every price piece of information from economic data to investor emotion is already reflected in the market price the moment it happens. So the chart itself is a complete summary of all collective knowledge. Principle number 4 is volume confirms the trend. Now, true price movement mustn't be accompanied by supportive volume. So what that means is if there's true price movement in the market, this must be accompanied by volume being added to the market as well. So if you see the market spike in a certain direction, but there's no volume, then you are seeing manipulation and a fake move. So when prices rise on strong volume, it shows conviction. When prices rise on weak volume, the move lacks substance. Number 5 on the list is trends must confirm each other. Dow used 2 indices, the industrial average as well as the transportation average. So when both moved in the same direction, it confirmed the health of the trend. If one diverged, it often showed warning signs for him, and this is how he based his trading from there onwards. Number 6 is a trend persists until it reverses. So I'm going to teach you all the full saying tonight of trends. Now, the final and most famous rule that Dow came up with, and all of you know Dow's 6th rule, and you're going to hear now why I say that, is trends continue until clear signals or reversals appear. Or in simpler terms, and this is the one that all of you know, and I guarantee this, which is the trend is your friend. But what people forget is they don't use the full saying of this specific, very classic saying to the market. So it is not just the trend is your friend. It's the trend is your friend until it bends and ends. So that's the full saying to it. So the trend is your friend until the bend and it ends. So that's a bit of a tongue twister though. That's maybe why people don't use the full one. So these 6 principles might seem very straightforward, but together they create the foundation of how every modern trader interprets markets. So now that we've covered the introduction, we're going to get into the actual meat of tonight's session. But before we do that, I have a question. Which of these 6 principles do you think traders violate most often? So which one of the 6 principles that we just covered, which is, the 3 trends, the 3 phases, price discounts everything, volume confirms the trend, trends must confirm each other, and the trend is your friend until it bends and ends. So which one of these 6 do you believe that traders violate most often? And I see we've got more people joining, and I see a whole bunch of hellos. Glad to see it. Welcome everyone. So yeah, let me know which one of these 6 you believe gets violated the most. Okay. Now, as I said, let's get into the nitty-gritties of today. So Dow believed that market moves in 3 waves. So let's break down each one of these 6 principles to see how we can use this in everyday trading. Now, just like the ocean, you have the big, powerful waves, and I'm using the ocean because, well, I live in Cape Town. The ocean's just there. So Now, that big, powerful wave, this is the primary trend. Then you have the medium-sized wave that retrace part of that larger move, which is known as the secondary trend. And then we have those small ripples that make up the day-to-day action, which is the minor trend. Now, the primary trend is the backbone of the direction that you are trading in. It's the broad directional movement of the market. An uptrend in a bull market or a downtrend in a bear market. The trend can last from 1 year to several years, especially if we're looking on larger time frames. But you can also apply the strategy or these principles on smaller time frames as well. So remember, back in Dow's time, they didn't have charts the way we have charts today. It wasn't live 1 second charts. These people had newspapers. They got a chart update once a day. A lot of them drew their own charts. So there would just be a newspaper article with the price, and they had to like draw the next price. So they had their own charts and they dot plotted it and then kind of drew it from there on forward. So to put it in this perspective, in Dow's time, there wasn't things like hourly charts and minute charts and second charts, or now even as we have them, tick charts. So understand why his core principles were those longer trends based on those time frames, and then you'll understand how you can break it down for yourself into lower time frames. So yes, as I was saying, as traders, those who align themselves with this movement tend to experience the highest probability of success. So then we get the secondary trend, which represents the temporary pullbacks or corrections that occur within that larger trend. They are healthy and necessary, and even the strongest bull market will experience dips. Now, these are opportunities, not warnings. And then we have the minor trend that represents short-term fluctuation, the noise. It can last a few days or a few hours or whatever, while these moves attract intraday traders. They really define the bigger picture. Now, just to show what this kind of looks like on a chart. So here you can see we have the red trend. This is our primary trend. So here you can see, so this is obviously on a weekly time frame just to show that bigger picture. But here you can see, if we have a look, this is a massive uptrend over a few years in that direction. Now, then within that you have these purple trends, which is our secondary trends. There you can see those pullbacks that come into the market, that come into play. And then we have the minor trends, which is these little bounces that we see here, which is just that little bit of intraday noise that pop into the markets from time to time. If you have any questions for me at this point in stage, please feel free to ask. I'm happy to answer anything that you'd like to ask. And I do see I have some people popping in now with accumulation, participation, and distribution. So that is where we're getting to. So that's the 3 phases that he spoke about, the second principle. So accumulation, participation, distribution is not the 3 trends. So we have 3 trends, which is your primary, secondary, and minor. And then we have phases. That's where we're getting to now. So Dow also proposed that every trend unfolds in 3 phases, which was accumulation, participation, and distribution. Now, the accumulation phase occurs when informed investors begin buying or selling quietly before the general public catches on. Prices may seem flat or range bound, but beneath the surface, The professionals are building their positions. Then after this comes the participation phase. So in this phase this is when the trend becomes visible. The public starts to take notice, momentum builds, media coverage increases, optimism or fear spreads, prices move strongly in the direction of the trend. And then finally, we will reach the distribution phase. This is when the smart money begins to offload their positions, those profit taking that we talk about so often, to the latecomers, So those driven by greed or panic, they're the ones who absorb these positions at the end of the day. And that's why we have a lot of people who still have losses. So the trend then starts to lose steam, volatility increases, and reversals often follow. Now, understanding which phase the market is in can help traders avoid buying near tops or selling near bottoms. A mistake that most traders unknowingly repeat. So just to show you a representation of what that will look like. So here you can see accumulation phase, then we have that participation phase, and then you have that excess, which is that distribution phase. So, and then after the distribution phase, you see that reversal. So you normally see, here you can see, so accumulation, move up. Here's obviously now that markup. Then we have that little bit of excess, and then the distribution phase, where again, you'll start seeing accumulation. So, but again, I'm using the word accumulation, or I should actually use consolidation as a better word here, because we shouldn't mistake accumulation, distribution phases for accumulation phases. So you have to kind of practice to identify correctly in which one of these various trends you are. And here you can see as well, so phase one, accumulation, then participation, and then the accumulation or excess phase. Now, again, what happens after this? It's the trends, your friend, until it bends and ends. And then you have the new distribution, public participation, and then panic phase instead of excess if it's a bear trend. Again, panic phase is that accumulation phase that then comes into play. I hope everything is making sense so far. Let me know in the comments if it's not. I try to structure the content as simple as possible so that you guys can also see, this is just pure price action and how it ties in to everything that we've been discussing over the last 4 to 5 weeks. So, as a question, of these three phases, which do you think most retail traders tend to enter the market in? Do you think most retail traders enter in accumulation, in participation, or in accumulation, which is that excess or panic phase? Let me know in the comment section. Maybe even add a little bit of a why if you want to there as well. I would love to hear that as well. It's making perfect sense. Wow, I love that. Thank you for that comment. I really do appreciate it. So now I want to move on to one of the most revolutionary ideas in finance, which is the third principle in Dow's theory, which is price discounts everything. And this is crazy to think about, but I'm going to show some practical examples here tonight as well. So Dow argued that the price itself is the ultimate indicator because it reflects everything: economic conditions, political events, and market psychology. He argued that you don't need anything but price action. So in practice, this means that we don't need to chase every new headline. Instead, we can simply watch the price. If it is trending higher, it means the collective market believes things are improving. And if it's trending lower, sentiment has shifted negatively. It's not about predicting, it's about interpreting what the market is already telling us. And I want to show a bit of an example here tonight, and I want to use a very recent example that we have seen within the markets. And this is so I'm gonna show the S&P 500 chart. So let me pop that up. Here we go. So here we can see on a daily time frame, obviously price is clearly bullish, okay? But then if we drop down to like a 1 hour chart, let's just go like all the way down. We can see this massive drop that the market took on Friday from Trump's tweets and so forth, and a little bit of news that came into the market. But again, if we're still looking at the general trend is still positive. We are still bullish. There's still this upward momentum that is not phased by the smaller pullbacks. Again, you have your primary trend, your secondary trends, and then your minor trends, as we just discussed. Now, as well, now you can see during this week, I mean, we're only on Wednesday now, but you know, during this week, yes, we had a nice bounce from off those lows, and the trend is slowly starting to move in that upward direction. Yes, we've had, you know, upward trend, pullback, upward trend, pullback. Now from here, we'll probably have another upward trend again, maybe to go and retest those all-time highs, pull back, and then we'll break the all-time highs. But again, these movements just continuously repeat themselves. It's kind of poetic in a way. There's no other way for me to really put that. So this was his theory regarding price discounts everything. So just something to look at when you look at your charts as well. So then that brings us to his fourth principle, which is the volume is the heartbeat of the market. So volume confirms the trend. And this is one that I personally believe that a lot of traders miss or skip or don't look at the way they should. So this shows how much participation there is behind a move. So according to Dow, when prices rise on increasing volume, it shows strong conviction among buyers. But when prices rise on low volume, it suggests hesitation. The same applies obviously in downtrends. So falling prices accompanied by high volume indicates strong selling pressure. However, if price falls but volume declines, it might signal a lack of conviction. So, just not a lack of conviction, but as well potentially the end of that downtrend. So let me show an example. So again, let's head back to that S&P chart. Now, if you have a look here, you see this uptrend that we had here. Let me highlight it as well. So here you can see market was rising very aggressively. I think we can all agree to that, correct? But now if I draw this green block a little bit lower, at the same time it will highlight the histogram here at the bottom. So if you look here at the bottom of the screen, that histogram also now gets highlighted. And you can see as price was moving up, volume was decreasing. And what happened? As price moved up, volume decreased, and at some point we just stopped, and what happened? It dropped really hard. And again, here we can see again, secondly, again, nice uptrend. But again, no real volume within the market. So we had that uptrend with no real volume in the market. So again, just a bunch of hot air currently. So what happened? When the volume entered the market, price had to correct first, which is what we are seeing now. And now if the price continues back up, which you can see now on that nice big rejection there, it's a big possibility. But if that now pulls back and goes all the way back up, look at the amount of volume that's entering the market now. This will be a much stronger trend with a lot higher conviction than these previous minor trends, or trend with no volume or lack of conviction that we saw. Here as well, we can see here, even if I pull this down to here as well, so we can look at that histogram. So look here where we had that massive drop. So you can see this massive drop in the market. And look at this histogram, like flying. But what happened? As the market continued to drop, volume started decreasing, up until just before market closed. There was almost no volume left in the market. The market was like, I'm done. I can't do this anymore. I'm over it. And what happened? Literally Monday morning, we just jumped up. And why? Because of the fact that there just was no more price movement to sustain that larger move. Is this making sense? Is something clicking for you here tonight? Let me know. Just I would love some feedback. So let me see here. I understand. I practice that volume principle often. That's actually really good. Well done. I love that. And yes, you know, as we go through the session, you guys are going to see a lot of the principles that we apply on a daily basis is already factored into or originates from Dow's theory. So yeah, again, let's move on to, I think we are now at the fifth one. We actually coming a little bit almost to the end of tonight's session. So, and this is the trend must confirm each other. So as I was saying earlier, you know, Dow used the industrial and transportation index to validate each other. So in today's language, we will call it correlating pairs. So even if you're using Forex pairs, you're using correlating pairs. So he reasoned that if the industrial production was increasing, transportation activity should also rise because goods need to be shipped. So if one index made new highs while the other lagged, it was considered a warning sign to him. Now, today we can apply this principle across asset classes. For example, confirming a rally in crude oil with a similar move in energy stocks, or, you know, certain currency pairs or so forth, if that makes sense. Now, here's a question for all of you. You know, can you think of two markets or even two sectors today that should move together but don't? And, or even let's do it opposite. What are two markets? Because I've spoken about this a lot in the last couple of weeks. I even made a video about it. And I had a colleague from Stan Lib on that video as well, where we discussed this as well, where we even have markets that are now moving together that shouldn't be moving together. So again, these are showing some problems within the market at the moment. So yeah, can you name two markets or two sectors today that should move together but don't? Or even two markets that are moving together that shouldn't. Okay. And then we come to the sixth principle, which is the trend persists until proven otherwise. So perhaps the most famous of all Dow's teachings, as I said in the beginning, which is the trend remains in motion until there's clear evidence that they have reversed. This is where patience and disciplines separate successful traders from emotional ones. So in other words, don't fight the trend. Don't assume it's over just because prices are, doing a small pullback. So wait for structural confirmation, such as a break in the series, or higher highs and higher lows in an uptrend, or lower highs and lower lows in a downtrend. Everything we spoke about in the last 3 sessions, and now we've added to this by adding change of character and break of structure, and all these are applying Dow's theory in modern markets, okay? So even though Dow developed his theory before the invention of computers and electronic trading, its principles apply perfectly in today's environment. So let's take a few examples. I mean, in the gold market, we've seen long-term uptrends defined by a series of higher highs and higher lows. And we can actually have a look at that quickly. So let's pull that up. Here we go. So here you can see, obviously, we're on a daily time frame here at the moment. Massive uptrend, and there we go, higher highs, higher low, higher highs, higher low. Now, all-time high, higher highs. So what is we kind of expecting? So this is public participation phase. We can clearly see it. I mean, we just spoke about the 3 phases. So here you can see there is that accumulation phase. Here we have the participation phase, so that distribution. Now we have to come to the excess, so where the offloading takes place. And I mean, if I zoom this out a little bit, we'll see this happen over and over again. So here you can see again, look there, accumulation. Draw it a little bit higher. So there you can see accumulation, distribution, and then it just kind of phases out from there. So here's that, participation phase, not distribution. Participation, there's distribution. And then as that continues, it then becomes the new accumulation and then participation. So now again, we're waiting for the next sideways market. So again, over 100 years later, we can still see each one of these phases, or each one of these principles, just repeating themselves. It's just over and over, showing how much of it is still relevant in today's market. So yeah. Now, that's just one example, and we can also see, for instance, if you have a look, article I wrote today, about crude oil. So here we can see the opposite has occurred at times, a clear series of higher highs and higher lows, and then defining extended bearish phases, like what we are in now. I mean, oil prices are just falling and falling and falling. I mean, even in Forex, such as Euro USD, USD JPY, the same concept holds true. It's not just stocks. So it's not about what you trade, it's about how you interpret the structure of the trend. Practical application and time frames. There's ways to also use this. So to use the Dow theory effectively, you must understand how to apply it across multiple time frames. You can't just be using one time frame. So Dow, for instance, started, if I can explain it in this way, in a way we would understand it today, he kind of started at weekly to identify the dominant trend, and then move to daily and to kind of find, his entries and exits. But what we can do from that perspective is, if you were a swing trader, start on weekly. move down to daily and 4 hourly to start, looking for those entries and exits. But if you're like me, if you're a day trader, you might start on 4 hourly, so look for that primary trend on a daily, and then, look for your 4 hour to identify your current trend. And then maybe on a 1 hour or 30 minutes, you start identifying your entries and exits. And again, I explained this multiple times during our SMC sessions as well. And I mean, even if you're a scalp trader, then you can maybe start on like an hourly, and then, or maybe even a 30 minute. And then from 30 minutes, drop it down to like a 15 or 5 or even 1 minute time frame. But again, using these multiple time frames consistently to help align everything. Now, this specific alignment ensures that your short-term trades move in harmony with that bigger picture, and that you're trading with the wind at your back, not against it. So for those of you following my series for the last 4 or 5 weeks, how many time frames do you currently use when analyzing your trades? Or are you still stuck on just analyzing on one time frame? Many traders fall into the trap of reacting to short-term noise, forgetting that the larger trend exists. Other traders exit too early out of fear or hold losing positions, hoping they'll turn around. Now, Dow Theory teaches patience and discipline. It reminds us that retracements are normal. They are part of the process, not signs of failure. So the Dow Theory isn't just history, it's living, it's breathing. It's a framework for understanding markets. It gives traders a way to simplify their approach and cut through the noise and focus on what truly matters. Price, volume, and trend. Those 3 things. Take time this week and maybe over the weekend. Look at your charts with Dow's principles in mind. Watch this video again. Write down those 6 principles. Put it on a wall. And then identify your primary trend. Confirm it with volume, and remember, trends persist until proven otherwise. Traders, if there's any questions, please let me know. That kind of brings me to the end of today's session. So if you found this valuable, continue your learning journey by exploring trend analysis, wave structures, and volume-based trading tools. Also go through the rest of the series as well. I would also ask, if you guys don't mind, I would love this actually, if you could all go to the Trustpilot website. And this is just a personal favor to me. If you don't mind heading over to the Trustpilot website, I'll show you here as well, and then looking for ATFX. So all you do is you just type here on the search button ATFX, and if you followed some of my sessions over the last couple of weeks, go and leave me a review. I want an honest review from you, how you found my sessions. If you found my sessions boring, please don't go leave a review. So if you found my sessions boring, it's okay. Just leave it. Say nothing. But if you found value in my sessions, I would truly appreciate it. If you wouldn't mind just heading over to the Trustpilot page, searching ATFX, and just leave me a review on how you found ATFX Africa educational sessions that we have been providing here. I would love some honest feedback from you guys on that. And yeah, also remember, tomorrow morning we will be doing another live version of the market brief. So live analysis, live setups, live assistance with your analysis and so forth as well. And that can go anywhere from an hour to 2 hours, depending on how many people show up. So please come join me for that as well. I would really appreciate that as well. Okay, let me see some comments. I wonder what I have no ideas about. Then I have Woolies and shipping. Yeah, that's valid. Good. That's pretty easy to apply. Feels like I subconsciously do that without even knowing until now. Thank you, Francois. Only a pleasure. So again, like I said, Dow was the founder of most of the technical analysis that we do today. So a lot of us already apply exactly what he said. Okay. Multiple time frames. Okay. Start to see how the story unfolds better and better every day, one step at a time. I love that. So how often do trends exist within trends? Okay. So as I said, every single market will have a primary trend. Okay. And every single market will even have secondary trends, so it's just those pullbacks. It happens in every market. There's no market that doesn't have this. There's one large primary trend, and then there's a secondary trend within it. And then we have those little movements, which is those minor trends or just noise. And it's not that it happens in 1 or 2 or 3 or 4 markets. It happens in every single one. Open any chart you want, you're going to find it there. So we'll definitely leave a good one. I appreciate that. I don't know who that is because it's using an alias at the moment. But you know what? I appreciate that. So I look forward to reading that specific review. And I look forward to seeing you all tomorrow in the live session. It will be up on the website shortly. So yes, looking forward to seeing all of you there. So have a lovely evening further. Have a blessed one. And thank you for joining. And as always, stay sharp, stay focused, trade smart, keep learning. Until next time.